Series. It's day number 124, and I want to talk to you about the basic concept called moving averages. And I already prepared a chart here. So what we see is S&P 500 as an index, and I have two moving averages in here. And the first one is the white one here. That's a 20-day moving average, and the red one is 60-day moving average. And before we start, let's think about what a moving average is. So basically in this case, we have the simple moving average. And what happens here is that we take for the last 20 or for the last 60 days the closing prices. So for example, this closing price here, we get another closing price here, another closing price here. And we take 20 of them for the white line or 60 of them for the red line. And we calculate the average, means we add up all the closing prices and divide them through 20 or through 60. And the reason why we do that is because we want to smooth out a little bit the volatility that we have. As you can see here, we're going down, up, down, and we want to flatten that curve, and we want to smooth these things out a little bit. So the very first thing that we get when we have a look at one of these moving averages here is that we can see as long as this line goes upwards, we are obviously kind of in an upward trend. And here when we start to go downwards, obviously the trend has changed and we're now in a downward trend. So that's the very first thing that we can see. And of course, the longer the time frame we choose for these moving averages, the less agile the curve will be. So as you can see here, while we have a turning point here for the 20-day moving average, the turning point for the 60-point moving average comes in later. And it's easier to see here, while we have a turning point in the 20-day moving average here, the 60-day moving average still is showing downwards. So we see that the faster the time period, or the lower the time period, the faster the line will react to the last day's changes. So very first thing that we can determine is whether we are more in an upward scenario or whether we are more in a downwards or downtrend scenario. Now we have different ways to deal with it. First, let me tell you something about the chosen days. There are different days that are, let's say, popular. So some people use 28 days, some people use 50 days, 200 days is quite popular, 100 days is quite popular. However, I think that actually, for me personally, when I use these moving averages in a moving average example, I always use 20, 60, and 200 or 250, depending on over long time frames. It doesn't matter as much anymore. And the reason for it is very, very simple. 20 trading days for me is 1 month, 60 trading days is 1 quarter, and 200 or 250 trading days is 1 year. So for me in general, I want to see later on when we talk about crossovers, whether we are likely going up or down over the next month, quarter, or year. And I couldn't derive that from 28 or 50 or something or 100. That wouldn't give me much. Don't know if these things work out for people that are using them, as these things or these numbers here are the most popular ones and most people are losing money in the stock market. I highly doubt that they work very, very well for them. So I use these things, and that's only for long-term trading anyway. The reason why we are talking about moving averages, or the reason I want to talk to you about moving average, is because this becomes the foundation in many, many other things. We already talked a little bit about it when we were talking about the awesome oscillator, and we will have other trend indicating indicators where we will get back to either simple moving averages or exponential moving averages, where we want to define what likely to happen in the future out of these infos. The very easiest thing that we can use to trade something is to determine, let's stick here with the red one for example, whether we are above or below the moving averages in terms of price. So here we would have price crossing, so we closed here, next day we closed here, so here we closed above both the 60 as well as the 20 moving average, and then we would have something where we could say, okay, that might be a buy signal or a good entry to buy something, because obviously it's likely to go up. That's what our 60-day moving average says. The same thing for the 20-day moving average. And we would stay long here in that market until here. That's the day where we eventually drop and close with our price below the 60-day moving average. That's when we would turn around and we would trade the markets down, and we would have stayed in a short position pretty much until, well, actually here, because here we close below, but here we close above for the first time, and that's when we would have gone long, and in this case we would have lost because Friday's close is below the 60-day moving average. So we would get ready now to short it again and to make money in a downwards move. So that's the very easiest way to trade it. We watch whether the price is above or below our moving average. And we can do that with different moving average. If you take the 20, we would have a buy signal here. We would have a sell signal actually here, just to get a buy signal here. We would have a sell signal here, depending on probably a buy signal here, or latest here. We would buy it again. Here we would sell it again. Here we would buy it again. So as you can see, the 20-day generates a lot of trading signals, while the 60-day is usually more constant. And that is one of the ways you can use it. The other ways is what would be referred as crossings of these lines. And let's stick with our 20 and our 60 day moving average. So basically, when we cross, the fast line crosses the slow line, and fast is the one with less days, so the one that's more agile. If that crosses the slow one from below here, this would be considered a bullish buy signal, and it's commonly referred to as something that is called a golden cross. So let's see. Black on black usually doesn't work very well. Let's make it in a yellow, so we have our golden cross here. So that would be our golden cross when the fast one crosses it from below. And on the other side, we would have another crossing point here, which would be referred to something that is called death cross. And the reason for it is pretty much because now we are going down, and this would be our entry signal. So basically, we would go long here, buy, and here we would have a sell signal. So we would go short. And as you can see, it would have worked quite well actually if you would have bought here and we stayed in all the way here until here. We would have made some money, and since we haven't crossed yet, we would still be in the trade. And you also can see that if you trade it like this with 20 and 60 days, you would have gone roughly like either this or that day somewhere here, and you would have gone all the way down, but since then you would have gone all the way up again. And let's say you bought it here, so most of what you gained is already lost. You might be lucky now that we go down further, which is one of my basic scenarios. I think we're going back down to 2,200 again. However, as you can see, sometimes following these things, you would have lost a lot of the money already made. Very similar here. If you bought it, that would have been roughly here at 3005, and when you, so here we have the crossing, and you would have gone short probably here at 3074. So that's like 40 points in here for all the time you held it. So basically from September to March. So that's pretty much no gain for all of that time. So you might realize that although you can trade these things and you're able to make some money out of it, there need to be way better ways in order to deal with these things. And we will come to a few of them in one of our next education videos, where we go into the details and we will see, okay, how can we actually deal with moving averages in a way that we get faster signals or that we get out of our trades earlier, and how to deal with trade management as well. So these will be some of the things that we will talk about in further videos. So in general, just a little repetition. Moving average is the average of a certain time frame which we can choose. I prefer to choose 20, 60 and 200 or 250 for 1 month, 1 quarter, 1 year. And many other people use 28, 50, 100, 200, whatever. And we can derive trading signals. First of all, whether the price is above or below one of these averages, and then whether we have a golden cross or a death cross. They create our buy and our sell signals, and we usually get quite a good entry. However, we often get out very, very late. So we need to find a solution how to adapt to these changes quicker, and there are actually several, and we will talk about that. So thank you very much for watching. If you have any questions on moving averages and how to use them, or any comments, let me know in the comment section. Also, if you have any thing that you want me to talk about in one of the next videos, let me know as well, and then we can pick that up and make a video about it. So thank you very much for watching. Have a great evening, and I'm looking forward to talk to you again tomorrow, which is another trading day, so we will be able to earn some money again. Have a great evening and goodbye.